The
Hello,
Fed's
everybody. It is Wednesday, April 24th, and it's time for our weekly live event. So we're going to start this session off, as we start all of our sessions off, with a review of our previous picks, see how they did, and we'll go through some market analysis. We'll answer your questions, and then, as always, Harry and I are going to have some new picks for you to follow. So, Harry, please say hi to everyone.
Hey everybody, how are you? Hope you had a great week, all of
that. Boy, if that doesn't excite you, I don't know what does.
Right there, right there.
All right,
message
so
right there.
I'm going to go over my previous picks from last week. We've been fairly balanced. We've been focused on day trading more than swing trading because we had this market pullback that was starting to form. We had nice intraday ranges, so you had an opportunity to be long or short on a day trading basis and to see how deep this dip was going to be and how long it would last. So one of my picks last week was CRWD. That was on the short side. And the caveat there was that the stock had to break below the 100-day moving average. And this is the day that it did that. And it dropped about $10. And that was on Friday, I believe. Here you can see there's the breakdown below the 100-day moving average, about a $10 winner for a day trade. That's all we're doing right now is day trading. You can see the stock has been able to pop back up above that 100-day moving average. My other pick was Google, and we were really wanting to see the market get above the 50-day moving average, which it did not. But you can see, all things considered, Google has actually been very, very strong, and it has moved higher, even though in the meantime, the market has moved lower. So, Harry, what was your pick last week?
I think it was Shop, wasn't it?
Shop, yep.
I think I picked Shop. I picked it. It was at around 70, 69, 50, 70 when I picked it. Obviously, you could have closed that anywhere up to 74.50. You can even close it now. It'd still be in profit. Nice bounce off the 200 SMA. Continues. Now we're looking at resistance at the 50. So if you're in Shop, this would be, and you're still there, this would be the day to close it. But either way, no matter when you closed it, you made money on that pick.
Yeah, really nice move. I mean, that's on a $70 stock, that's a $5 move. So that was an absolute beauty. I should mention that on my Sunday video, I did not give you a short pick because I have been looking for a market bounce. My long pick was BAC, and you can see that from the video on Sunday, which would have been right here, this stock has gone up very nicely. So that's been a great pick. I still like it. And in fact, last week, both Harry and I were talking about the market and how it's come in. So let's do a little market analysis. And you can see this is where the video was last week on the 17th. So we were starting to see some market weakness. We had this long red candle through the 50-day moving average. Tuesday, we did not rally off of this low at all. We did not try and retrace any of that long red candle. That was somewhat bearish. So we knew that we still had some downside pressure, perhaps to the 100-day moving average. And you can see that we are starting to get a little bit of a bounce. But neither Harry or I, and he'll chime in on his market analysis right here, I am leaning on this strength that we've seen since November. Okay, that tells me that we are going to get a bounce, and it should be a pretty decent bounce. And so this will be a good entry point for some longs. And it's like pulling a rubber band back. When you let go of that rubber band and you try and shoot it across the room, the first 2, 3, 4 feet of flight, you're fairly certain that that rubber band is going to move forward and with decent velocity. And it's going to be the same with any kind of bounce. But we want to see the market get through this 50-day moving average with long candles and heavy volume. We've got lots of news coming up right now. Should that happen, we're going to get some short covering, and it's going to fuel the move higher. And we know buyers have been interested. So we've got starter long positions on right now. We're waiting to see what happens at that 50-day moving average. If we blow through it, not peck away at it, blow through it with a long green candle, excellent. That's what we're looking for. That's where we add to long positions. And then we're looking for even more follow through AVWAP-Q and perhaps even to challenge the high. If we don't get that, and we're kind of waffling around, we're not able to get through these resistance levels on the bounce, then we start taking off some of our long positions in here, and we start getting more neutral and perhaps even watching for a lower high double top. We're not guessing. We're just trading off of the price action that we see before us. So, Harry, what's your take on the market here? What are you looking for?
Well, I just bought back the short. I have a crowd called debit spread. Obviously, crowd down today, but I just bought back the short calls for $1.57 profit on the short leg. Obviously, I'm still bullish overall on the market. Look, there's huge earnings coming. Meta now, ServiceNow, IBM tonight. You have the Fed's preferred inflation measure reporting tomorrow morning. So you have a lot of things that would be considered market movers. Any one of these, I mean, maybe not IBM, but or now, but Meta earnings certainly, Microsoft earnings certainly, the PCE number certainly, definitely, all huge market moving numbers. Could they all go the opposite direction? You get bad earnings on Meta, bad on Microsoft. Inflation still comes in hot. Yeah, obviously the market's not going to be able to withstand that kind of pressure. But when we make, market projections and we're looking at the market, you're doing it based on all else being equal. All else being equal, if those things were neutral, let's say, or came in at expectations, where would the market go? Well, the natural tendency right now, the look in the market is that support held. It dropped below support. It came back up and it blew through it yesterday. You could argue, is this a dead cat bounce? Maybe. But with support, dead cat bounce would have acted a bit more different. There was a decent amount of buying volume here, and you have support holding. However, it is important to note that the market is staying right around that key support resistance area. Let's call it SPY 500, right? Why is it doing that? Well, because, like we said, all these major events are occurring, and it doesn't want to stray too far, which means that, these events might have oversized importance on the market. And it's, without knowing what they'll be, and anyone says they do or guessing, it's hard to make a call. But if I had to, and I'm flipping a coin, I'm gonna take bullish as my overall bet where I'm leaning.
Yep. And so with the news coming out, and I had posted this morning in my comments, I said, okay, at some point you've got to take a stand. You can't always be in risk off mode. And when we get a pullback like this, I'm going to view this as a normal dip in a bull market. And so that's why I'm confident that we're going to get a decent sized bounce, and I'm going to evaluate the bounce. And so a lot of people might say, well, into Meta earnings, into Google earnings, into Microsoft earnings. Oh my God, the GDP and the PCE deflator coming out. How can you have an overnight position with all of that news coming out? Well, I feel that the GDP tomorrow is going to be neutral to possibly even bullish, even if the number comes out fairly soft. 2.5% growth is what they're looking for in Q1. Let's say it comes in at 1.5%. Ooh, that's bad. The economy's weak. Well, the initial reaction is going to be, oh, economy weak, goody, goody. The Fed's going to cut rates sooner. And that's what the market's kind of been looking for. So you'll have that buffer initially. Personally, I want to see continued strong economic growth. If the number comes in strong tomorrow, I don't think it's going to spark a big market decline. I just don't think the market's going to pull back on a strong GDP number. It's going to be good for profits. So I don't see that as being a great threat to being long overnight into the number. The PCE deflator on Friday, I believe it comes out. That could be a little bit more threatening because inflation has been weighing on the market. And
Is that
as
a
far as
Friday number or a Thursday number? It's
I
Friday?
think they have their implicit deflator that comes out in the GDP number tomorrow, but then they have a separate component that they release. I think it's on Friday, which is just the PCE
Right.
deflator. So they can back into the number tomorrow pretty confidently. But the earnings that are coming out, I also see as having more upside potential than downside potential just because of one thing: AI. Oh my gosh, AI. That's all anybody wants to talk about. They don't know how it's going to play out. They don't know how it's going to be monetized. But the potential for AI and the fact that everybody thinks it's the next big thing, well, the tech giants are going to be right in the thick of it. So even if they miss on earnings a little bit, it's going to be the prospects of AI and the potential that it has that keeps those stocks treading water. Okay, so now I've got a couple pieces of information that told me that the market should at least tread water and possibly head higher, and that's consistent with the bounce that I'm looking for. So those are my thoughts, and that's why I feel confident taking swing positions, initial swing positions, with the intentions of adding above that 50-day moving average if we blow through it.
By the way, I just want to note that I added to my Apple position just now. Really like the strength I'm seeing in Apple today. I have those long-term August calls. They're pretty far out. They're kind of like mini leaps almost. So I just added to that. And this morning I went long on BABA. BABA will probably be my pick, by the way, although I'm still debating that. But I did add to Apple here, and
beautiful strength. I mean, look at the relative strength. Here's the market down the whole day, just selling off. And this is actually a little bounce that tried to get going. And look at how that got smacked down. So they're still probing for support. The market should continue to leak oil in here. But look at Apple. Strong. And let's take a look at BABA. So I'm going to put that chart up so you can tell everyone what you like there.
Like a couple of things. So in particular on BABA, if you want to put that to the daily chart first, what I liked was that higher low there. You see it 4 days ago. There's a nice higher low from the low that you got around 2 months ago. So you have a higher low on BABA. Then you have some pretty organized buying going up to these two SMAs that are converging here. Both of those candles are finishing close to their high of the day. Today, you're going above those SMAs, and despite the fact the market being down $2, BABA is still up $1.18. So you have, I have a decent, you have pretty good relative strength. You're looking at this market drop. Yeah, you're getting a little dip below VWAP here, but BABA is still holding its own. So with all those combined, I see that BABA tried to break those SMAs before. It fell below, but now with the lower high, with the higher low and the organized selling closing at the top of the day the last couple of days, and today's break of two SMAs all at the same time, it's one of the reasons I really like BABA for a long. I think if this market starts to get going, BABA's just going to take off with it.
Yeah, that's nice. And so something to be aware of is that oftentimes you will see stocks gap up. So the market gapped up, a lot of stocks gap up. And you don't know the good from the bad, the head fakers that are just following the market versus the ones that have real relative strength. Well, this is the tell. When the market starts to pull back and fill in this gap and it continues to sink lower, if BABA was just a fake, wham, 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 they would have played whack-a-mole with this stock and they would have knocked it right back down. It would have filled the gap, and perhaps even then it would have kept going. But look what it's been able to do. It's been able to preserve that gap all day long with this type of market selling pressure. And one other supportive argument in favor of your position is FXI. This is China iShares, And this is something I pointed out earlier in the chat room. Okay, so China's the weak link right now. I mean, their economy is struggling. It's one of the reasons Tesla's numbers were so weak. Apple reported that iPhone sales in China are down 19%. So look at what those stocks are doing. They're breaking through this horizontal resistance. They're testing the 200-day moving average, and they're through all of these trend lines right here. So Harry's also got Chinese stocks providing a tailwind.
Yeah, I think if that stays, we're going to have a good, also we have earnings pretty far out on Baba. So technically I like it. I like the setup. I like the context that it's in. But again, a lot of these things are market dependent. It's why I bought, I did the SPY strangle for $8. I sold the calls for $8, but it allowed me to keep the puts on, giving me basically a free hedge on my entire account. So that strangle is working out well, giving me a nice SPY hedge on the account there. Interesting question here. Get to real quick. When evaluating your journal at the end of the month, do you take on any huge profit outliers? For example, the GL bearish explosion, et cetera, et cetera. So basically what you're saying is, yeah, okay. So let's say, you're doing it right. You're trading and you're treating it like a business plan. And in your business, you need to make $5,000 a month, let's just say. That's your business plan. And you want your average to, you don't want $5,000 a month to mean 1 month you mean 10,000 and the next month you make 0, right? No, I'm averaging 5,000, because swings like that aren't, show that you could also go down to a negative 10,000, right? Or a positive 20 and back and forth. There's no consistency there. That's not the type of business that winds up doing well. For businesses that do well, you need some consistent growth. You don't need these wild swings. However, there is sometimes consistency and inconsistency, which means if you find that, okay, on any given month, you typically have a few profit outliers, but you also have a couple of larger loss outliers that cancel each other out, right? And most of them wind up in the middle. It is a slightly more it's a slightly more dangerous way to trade, but as long as that average stays, you don't want to stray too far from the average. So what you want to do is look at your overall standard deviation off that average, not so much any particular outlier. Now, sure, of course, if you had one trade that made $20,000 because you went crazy and you bought a bunch of out of money puts on Nvidia, the day of that huge drop, and bam, you made 25 grand. That's an outlier, right? You don't want to count that in your average. But if you are looking at your overall standard deviation off that 5,000 a month, and let's say your standard deviation is, I don't know, $500. That means that 95% of the time, your average month is between 4,000 and 6,000. Is that range compatible with your standard of living, of what you need to do? 95% of the time, you're going to come between, that's what that means, is 95% of the time, you're going to come between $4,000 and $6,000, and 5% of the time, you're going to be either 2.5% of the time you'll be below 4,000, 2.5% of the time you'll be above 6,000. If that is okay, then you're trading fine. So you need to look at your standard deviation. One standard deviation plus or minus your average, that's 68% of your time. Two standard deviations, 95%, three, 99%. You look at it that way and you say, okay, if this was a business, is this okay? Is this an acceptable range? Am I willing to be okay with the lower end of this range on 1 month and the higher end on another month? If not, then you have to tighten it up, right? You don't get rid of those outliers, you tighten it up. You make sure you don't have them. So it is a good question, but it really lends towards treating your trading like a business, using your journal that way, and keeping an eye on your profits and keeping an eye on your averages.
Yes, and a lot of your profitability is going to be dependent on what the market is giving you to work with. There are going to be modes like we've had for the last 2 weeks where, okay, I'm not really able to swing trade in here. In fact, in here, we weren't even doing that much swing trading because the market had no pace, no direction, starting to stall out. Obviously, when we got this long red candle here, that was complete warning sign to just go to the sidelines with all your swing trades. And so in here, we're day trading. Well, back here, when you're able to have some long swing trades that you had on as swing, positions for, say, a week or 2 or 3 or 4 even, well, you had those constantly working in your favor. Plus, you're able to day trade. So you had really nice opportunities to make money. So in here, you're going to be making the lion's share of your money. And now you get into kind of this holding period. Well, what you make here has to feed you during periods like this. And so now you get to kind of some lean times, some good day trades in the last week or two. Now I'm setting up for a window here. I think we're going to get a decent bounce. And if it stalls out, fine, I'll take my profits and I'll wait for possible opportunity on the short side. But this is a nice window of opportunity. We've been waiting. Now we're starting to get it. We're in our starter long positions, and we could be adding if the market goes through the all-time high, which I've got to tell you, I think very, very few people are looking at a possible bounce right now that could take us to the all-time high. I'm hearing so many bears crawl out of the woodwork. Have you heard the same thing, Ari? I mean, I'm hearing bears everywhere.
Oh yeah, and they're usually the same people that just a few weeks ago were basically saying SPY's going to 600, and now all of a sudden, 420, 430, it's coming. We're all collapsing, and they're using reasoning that was there 2-3 weeks ago. But then they were bullish. Now they're not. So I don't really pay much attention to them. I'm looking at that 500 level and saying, okay, that's my line in the sand. And if SPY stays over it, we're bullish. If it doesn't, we're bearish. And obviously, like we talked about, those releases will play a big part in that. And the earnings is difficult, particularly this quarter. And the reason why is the market has been relying so much on rate cuts. And, it was pointed out, when the economy is going as good as it is, why the fuck would you look for rate cuts? 5% is a normal number. So why? Just because we've had free money for the last 8-9 years, now all of a sudden 5%, looks crazy, but that's actually a normal number, and the economy's humming along. Why is anyone looking for rate cuts? But they are, and it looked like they're going to be certainly less than they were hoping for. So that puts extra weight on earnings, which is to say, okay, fine. No rate cuts are going to propel this market at the moment, but a good economy should propel the market. So if the economy is great, then that should be reflected in the earnings of these companies. It should be reflected in consumers. That's why there's going to be so much weight on these earnings, and why, we're also seeing some very strange earnings reactions. I mean, Netflix blows away earnings, drops. Tesla just basically the worst earnings they've had. You don't get, as a car maker, you don't get any worse than the earnings that Tesla had. The rest of it is just, vaporware and bullshit, but that he's tossing out there. But Tesla jumps. So you're starting to get some very strange reactions to guidance on earnings, whether it's real or not real, up in the air. But at the end of the day, revenue is revenue, and you're going to need to see these companies compensate for the lack of rate cuts to propel this market higher. However, we could get bad economic news, as a lot of economists are now saying. And if that happens, well, then you'll start seeing hope again on the rate cut side.
I've got a question that came in on VIX crossing 16. Is that a concern? I have access to VXX on my charts here. I'm not concerned about option implied volatilities. You can see how they peaked out here and how we have these downward sloping trend lines, and we've got a high plus trend line here that served as resistance. And you can see how VXX has dropped back below the 200-day moving average. We've got a low plus trend line breach here. So option implied volatilities are coming in. They're falling. They are not increasing, which would actually be supportive of a market rally as well. But in general, anytime you get a spike in option implied volatilities, institutions, everybody, they are trained to hammer that volatility down. So no, I'm not worried about that at all.
So in what I like, Clorox, relatively strong, broke 200, then 100 SMA with high volume. Any thoughts? So looking at Clorox, I do see what you're saying. It does have a nice orderly upward trend. It looks like a low is put in on 415, matching sort of the 124, 125 low. There's still a lot of resistance above here at 149. It's pretty close. You don't really have a confirmation of that SMA 100 break. It's not a terrible long. It's not a long I would take, though. There's just too many things that can go wrong and too many stop points along the way. But there's no doubt it's bullish and it's very relatively strong today. It's a strong stock. It's good for a day trade, certainly. If you're looking for something to be bullish on today, for example, going long Clorox is probably a decent play. But long term or swinging it, I wouldn't do that. But as a day trade, sure.
I'm going to put up my long of the week, PANW. And this is actually a stock that was coming up on some searches. I know Harry had highlighted CRWD, so he likes the space as well. Here's what I liked about PANW. When you get a stock that falls like this, it must form a base over time. And this has had a couple of months to form this base, and now we saw horizontal support. Now we're seeing a higher low in here, and the stock had started to rally off of this support when the market was still going down. And at that time, about a week and a half ago, I suggested selling an out of the money bullish put spread below this support level. That was a nice play. I like the fact that it's been able to challenge now the 50-day moving average. It just looks good to me. I like the fact that it's been above this high minus trend line here. Had a nice solid day yesterday. It's not quite through the 50-day, but that's okay if you are selling an out of the money bullish put spread. And that is how I would approach this. And you could go down below the 200-day moving average, which is the black line. And that comes in at 273.70. Earnings are past that May 17th. You need to confirm the earnings date because I have not confirmed it right now, but I believe it's past that May 17th timeline. So if you just look at where those options come in, 270.50 and 270, you need to be able to get 50 cents for that. It's 37 cents bid offered at 58. It's possible, especially if there's any kind of little dip in here, and that puts you safely down into this area right here. We've got a nice uptrend line providing support as well as that 200-day moving average. That's how I would be playing this. And the stock's got relative strength. So that is my pick of the week.
I'm trying to figure out what someone is referring to, W or BW. So if Pete and Harry, if stock bounces off a support or resistance line once, does that line stay valid or gets weak for a second retest? It depends on what support and resistance line you're talking about. If it's a 5, if you're talking about VWAP or you're talking about 50 SMA, but bouncing off once is just a test. It's just a bid check sometimes. If it bounces off and it holds, then you're generally it gains some strength. The more it holds, the more it gains some strength. Depending on also the volume of the retest, depending on the stock, depending on the situation. And you're talking about, is it an earnings drop? Is it just following the market? Does the stock have individual relative strength and weakness? You have a stock that has strong relative strength. Let's say on a day like today, comes up to an SMA resistance, drops back down, and then tries to retest it. Well, that's something worth keeping an eye on. It's something, you set an alert. And either way, your best case scenario there is you just set your alerts. Set your alerts on a break of those support and resistance lines, and then watch it. Watch to see if those alerts are confirmed. Watch if that break is confirmed. If it is, you might have a good trade setting up.
Yeah, to your point earlier, you can't just make statements like that and generalize. Hey, if you get this, do you normally see that? Yeah, it has to be a specific example. Okay. What was the market doing at the time? How did the stock get to that support? What path did it take from point A to point B? Did it have long red stacked candles and it bounced off of support for one day? Well, that's not enough. That support is likely to fail. And when it does test that support, let's say that it's just bumping, grinding down to this support level, very weak pullback, bounce, bounce, bounce off of that support level. Okay, well, in that instance, yes, that support might hold. It's always better if you bounce off of support that you get a retest that doesn't touch that support level, because it shows that buyers don't believe it will get there, and they're so aggressive that they want to buy it before it gets to that support. They see that retest as an opportunity to add to their position. So you get a higher low double bottom. That's what you want to see. Like here, higher low double bottom. Buyers did not feel that PANW was going to get back to this horizontal support. So they're buying here. That's what we want to see.
Let's see here. What's looking good on a short side, just in case here. Let me take a look at Roblox. Roblox is an interesting short here. Look at those dancing right around the 200 SMA, right? And then you see it like it goes above it, fails at the 50, comes back down, falls below it again. It keeps trying to get above. And now look today. Today you get a gap fill, and the gap comes from way back in November 8th. A gap fill drop today below the low of yesterday and the day before. You got a lot of weakness going on here in Roblox. That's not a bad short setting up if one wanted to have a decent short in their arsenal.
That's a beauty. Yep, you got this. You had this low minus trend line breach. You just recently had a low plus trend line breach, as you stated, that rejection from that 200-day moving average. And you can see how nice and tight the price action has been today on heavy volume. Yeah, that's a nice short.
In fact, I might just take it. Let's see here. What would I take if I'm looking at Roblox? Let me see. Earnings on Roblox is on May 9th, so I have some time. So if I go out to May 3rd here, and I'm looking to go maybe you take the 36 strike puts, 0.71 delta there. You can get those for $1.88, probably somewhere around that. And I can just grab, let's say I grab 6 of those, send it in, and there we go. So, okay, I just short Roblox. I've used using the 36 strike puts for May 3rd, and I got 6 contracts for $1.88. I might use the other account and go maybe grab myself 200 of those, but for the moment, let's just keep that on there for there. Okay.
So in Red Royal Flush, I just happened to bring it up because I thought, let's take a look and see if we got any other good shorts that are setting up here. Well, Roblox is right there. You can see
Yep.
I've got our buy and sell signals from a 5-minute to D1, solid red, and then we've got relative weakness, 5-minute to daily chart, all the way across, heavy volume. It's so dang easy to use these column layouts and instantly spot the best prospects. And as I go down the list, you see Home Depot is testing that 200-day moving average. So that's had relative weakness. Look what it did yesterday when the market bounced. Couldn't get off the deck. So you click GTC, you click on a low of this candle, and if it breaks through that, and if we do get weakness tonight, tomorrow, the next day. Home Depot looks good. Look at Uber here. That's a really nice one. See it poking below that 100-day moving average?
Yep, and that comes off the robo taxi, whatever the hell he's calling it, news
Right.
on the Tesla earnings call. Both Lyft and Uber responded to that negatively, of course, because that goes right to their business.
Yep, and Lyft also breaking below support, but the Uber breakdown looks a little better to me just because the stock is kind of crowning, and you can see from the last month's worth of trading activity, the stock has just been gradually leaking oil. I love that pattern because that tells me that somebody is out there selling this thing and the pressure is just constant on it.
Someone wants to know what I think of Coke as a long. Well, Coke is a coma-inducing fucking stock. I mean, it's just bouncing around here between its SMAs. It has some natural horizontal resistance at 61.50, which is right up against right now. To tell you what, Coke gets to 62, go long all day long. But until then, you got that horizontal resistance. I mean, look, February 21st, 22nd, 23rd, 26th, March 13th, March 27th, March 28th, April 1st. These are all days where Coke approached the same number that it's looking at right now. So put an alert, Coke 62, and it breaks it. Yeah, Coke is it. Buy the world of Coke. Have a Coke and a smile. All that. But until then, just look at the daily chart. Everyone look at the daily chart. Daily chart, daily chart, daily chart. That's the first thing you should all be looking at. Well, obviously you see the intraday chart, like, oh, that looks good. Go to the daily chart. Does it still look good? Is there maybe anything around it that you would think is, oh, this is going to be a little problem area? Set an alert, move on. That's it. Simple as easy as that. Set an alert, move on. I looked at Roblox. I said, okay, I didn't have an alert set for that. I saw it on the Red Royal Flush, but I didn't have an alert there. That's the benefit of having these scanners staring at you right in the face where you go, oh, bam, there's one. But I looked at it and said, okay, there's nowhere I would set an alert here because it's already broken through. It's done what, if I had noted it yesterday, it has already broken whatever alert I would have set. Therefore, it's a good short. Most of the time, though, you're going to look at these daily charts and say, it's not quite there yet. Set the alert and move on. Just that's it. Done, next. Done, next. Occasionally, you'll see a Roblox where you go, oh, there's no alert to set because it's already broken through everything I think it needs to. Now I can just take the trade. Daily chart, daily chart, daily chart.
Got an interesting question here. The NYSE is considering 24-hour trading. How do I view that as impacting current market, and what will that mean to retail traders in the future?
It means they're fucked.
Yeah, well, you would think that you're going to work a lot more hours. You definitely are going to be more dependent on setting alerts, especially on the indices, so that overnight, if something happens while you're sleeping, you want to be aware of it. But in general, I think that most of the liquidity is going to still stay within our normal trading hours. And right now, you could trade S&P 24/7. When does most of the volume happen? It happens during our market hours.
It's still the equivalent of giving the pyromaniac a Zippo. I mean, because what's going to happen is these addicted retail traders are going to hop on at midnight into these low volume movements and go, oh, well, look, Tesla looks good. I'll grab it now. And because there's no volume in it, they'll think, oh, I got it at this price or I got it at that price. And the next morning they'll wake up where the real volume comes in and go, oh, shit, I'm fucked. And, or they'll realize that they can't unload their positions at 2 a.m, shocker, because there's nobody on the other end ready to buy it. So they'll be stuck in those positions. They'll think they could day trade between midnight and 2 a.m. Yeah, as Pete said, unless you see some volume going on, the only benefit I can see to 24-hour trading is if there's a big news event, right? It happens at 11 at night and some some major news occurs that would affect the stock, it allows you to perhaps jump in and get in earlier than other people who weren't paying attention or monitoring or before the algos take over. And you might have a slight advantage. But in terms of like just day trading it or swing trading it, it's like a 24-hour casino. Try playing poker in a 24-hour casino on a Wednesday night at 3 a.m. Good luck.
Let's see what else we've got here in terms of questions. GIS, TSN. So, we're getting a lot of questions right now. The one thing that you can see, the common theme, Coca-Cola, Clorox, Procter & Gamble, TSN, GIS. These are all consumer defensive stocks, consumer staple types of stocks. So there is a bid within that particular sector right now. And it does tend to be a flight to safety type of play. With this market pullback right here, you're seeing some rotation into some of those safer names. If we get the market bounce that I think we're going to get, you're going to see perhaps a rotation out of some of those stocks and into some of your tech names. So we're seeing nice relative strength, good rotation into them, but I think that's more of a kind of a flight to safety play right now. You also see that those stocks, by the way, Coca-Cola, Pepsi, as Harry is just mentioning, Coca-Cola is about as boring as it gets. So the fact that it's got a little bit of a bid to it right now does not mean that it's going to continue to break out. You can see how sideways this stock is over the course of the last 4 months. It doesn't go anywhere. Does it have periods where it increases and decreases? Yes, it does go through little stretches like that because it's a stable company, fairly boring.
I mean, if you're looking for a boring but good stock, I would choose like something like Tyson, right? TSN. You look at Tyson Foods right now. It's staying above its SMAs. It's not too extended. It's a nice orderly buying going on. Nice stepwise. Today it breaks out even more. You have that February 5th high of 61.21, but it's above that too. So if you're looking for one of those consumer defensive type stocks that might be better than Coke, I would take something like Tyson. I would take maybe even if you want something a little choppy. Yeah, Tyson. I was looking at Campbell's Soup, but Campbell's Soup suffers the same problem as Coke right now. So I would look at TSN as a better bet of a nice steady performer than I would look at Coke.
Let's see. We did have a question today in the chat room, which I thought was a pretty good one. What do you do with a stock like Netflix where you get long one day and it looks absolutely gorgeous, and then the next day, and you hold it overnight, and then the next day it looks like garbage? Well, it's a good question because this is the type of stock that you want to day trade when you get a bounce through the prior days open into the gap in here. So let's take a look at the 5-minute chart. And so this is what you're trading off of yesterday. Hey, wow, look at this. This is beautiful on good volume, nice tight price action. Yay. This is a day trade only. Why? Because this D1 chart sucks. Okay, it bounced temporarily off the 200-day moving average or the 100-day moving average, but look at this gap here. That is telling you that there is some selling pressure. So you've got to let this base form over a number of days. After earnings, I like to wait 10 days because you're going to get lots of volatility, and it's going to take time to figure out which way this stock is actually going to go. And then you can start to make heads or tails of it, but you'll have that base that's formed. And then if it starts to curl up and get through this resistance and into this gap, then you can take a day trade and perhaps even contemplate holding some of the position overnight. But you need constant confirmation that these sellers are out of the way. And you did not have that yesterday. As Harry pointed out, this is a dead cat bounce. This is short covering. People taking profits on short positions into that earnings release. So they're short here, they're taking profits here.
Justin Lee, you poor bastard. I'm still learning options trading. I took some 719 MU 130 and 150 calls, but they have nosedived. Even if the stock has movement after its earnings in 626, the time decay eats into any profits. Any suggestions on how to best play the situation? Just trying to learn how to best get myself out of poor decisions, minimizing risk. Well, let's just go over your poor decisions here. 1, you took out of the money calls. Poor decision number 1. Why? You shouldn't have. 2, you took calls that span earnings. Why? You shouldn't have. Poor decision number 2. Poor decision number 3. You played options while admittedly saying, I'm still learning options. That is your worst decision so far. You should not be doing that while still learning. You should be paper trading them, maybe, tops, but not playing them, certainly not playing them out of the money, and certainly not playing them over earnings. What you did was the equivalent of buying some lotto scratch-off tickets and hoping that you would hit gold. You didn't. It's done. You can, I don't know. I'm not even going to look to see how much money is in them. Probably almost nothing. It's probably not even worth closing the damn things now. Maybe MU goes on a huge run in earnings and you make a little bit of your money back. I hope it doesn't, because that will just reinforce the bad behavior. You should stop what you're doing. Stop trading with real money. Go look at the 10 steps that are clearly outlined. Hit your milestones. Use paper trading. And then when you finally achieve those milestones, move on to real money and maybe one share. And then when you hit milestones again, and we're talking you're about 2 years older than you are now, maybe then you should start using your money to play options. But until then, talk to me in 2 years. That's about as far out you are from having to ask that question again.
Yeah, you got to get the market right first. That takes a long time. Then you've got to get the stock right. That's the second part of the equation. The stock did have a nice earnings reaction in here. I liked it in here. I liked the fact that it continued to march higher post earnings. That was a sign of strength to me. The warning sign came right on that long red candle on April 4th, when my suggestion to everyone was get the hell out of every long swing trade, go to the sidelines. I don't know we're going higher or lower. I just know we're going one way or the other. This is a time for caution. So if you'd have done that on April 4th, you were still in decent shape. Yes, you should never buy it and hold over earnings announcements. That's a 50-50 proposition. We can have much better odds trading after earnings or before earnings and not holding over the number. But market first, market first, market first. Probably the biggest mistake that I see traders make. And that's why it's my first focus.
Try to think of out of the money. I used this example before, and I'm going to use it again, so hopefully it'll get through to some people. Try to think of out of the money options like this. And there's a rare time where out of the money options might make sense. You want to buy a house. The house currently goes for $1 million. An out of the money option would be like saying, hey, look, if I come back a month from now, I want to be guaranteed I can buy this house at $1.5 million. And hell, I'm going to pay you $50,000 to lock in that $1.5 million price. Now, the only way your play there makes sense is if a month from now, that $1 million house is now worth $1.55 million, right? $1.5 million, and then $50,000 on top of, because that's what you paid for the privilege of being able to buy that house for more expensive than it's currently worth. Now, the only way that makes sense is, let's say you had some inside information that they were going to build a amazing golf course and park and all that right around the house, and that the school system was about to get a huge grant from. So you knew housing prices in that area were about to explode. So you're going to lock in, right? But in that case, why not just buy the fucking house for $1 million right now? But maybe you don't have $1 million. Maybe you don't ever intend to buy the house. Maybe you just want to take that $1.5 million contract you got for $50,000, and then when the house goes to $1.7 million, sell it for $200,000. Okay, so you're betting on a 70% increase in the house's price to be able to make your money, 4 times your money. That's what the thinking behind out of the money options are. You're paying for the privilege to buy something at a more expensive price than it currently is. That's what you're doing. That's why what you're looking at is, oh, it's cheap. It's 40 cents. I could buy 100 of these. Blah, 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 blah. Well, smack yourself in the face. No, it's bad. It's not good math. It doesn't make sense. Only in rare cases does it make sense. And trust me, you're not at a point where you know those rare cases.
Yeah, anytime you're buying out of the money options, especially ones that expire with very little time till expiration, I call that an ice cube on a hot Arizona highway. It is melting quickly, and you don't need to be right. You need to be absolutely perfectly right. If that stock just sits still for a matter of a day, you're losing money on it very, very quickly. And when you span earnings announcements, those options have an incredible amount of option implied volatility in them because there's uncertainty. As soon as that earnings release comes out, the cat is out of the bag and you have a volatility implosion. They collapse. So you have every odd stacked against you. And if you still don't know how to pick stocks and you still don't have the ability to get the market right, you are so far behind the 8 ball. There's no chance you're going to make money. So yes, please stop.
Thoughts on Kava? Good short, not a good short. Look, I had Kava 2 weeks ago, made me sick. So fuck Kava. But yeah, I mean, SMA 50.
You mean you ate there and it made you sick, right?
Yep,
just to be clear.
Pretty much.
Okay.
I got a bowl, Kava bowl, lamb, whatever, blah, blah. It tasted fine and then felt like crap. Not doing Kava again. I see this break in the 50, but look at this. This thing hasn't had above average volume in it since, I don't know, almost 2 weeks ago. It's been 2 weeks since you had any volume above average. So you have a low volume break of the 50 SMA, which you've had for the last 3 days. It doesn't have as an ATR of 3, which is about 5% of its total price, a little high. It's well within that range today, so I don't really see anything today on Kava that would make me go, this is a good short. I'd much rather short Roblox.
I'm sorry, was that a short that they were looking at?
Yeah, they were looking at a short on Kava. I mean, to me, Roblox is a better short.
Yeah.
So
I would agree.
And sometimes
with that.
that's all it comes down to, right, Pete? I mean, you got two, and you go, oh, this is a good short, but this one's a better short. Okay, well, take the better short. I mean, there's no reason to take a short like Kava when a short like Roblox is hanging out there.
Exactly, and it's an allocation of resources. We're always, I use the analogy, we are the Pony Express, okay? We ride the fastest horse we can find, and when it tires, we get on the next horse. And so you're always looking for the best prospect, and you do not want to have a basket of 10 or 12 marginal prospects. What you want is you want 3 or 4 or 5 really, really good prospects that you can add to because they're constantly confirming trend strength or trend weakness. And when you start building those larger positions, that's when you can make some hay. And it's easier for you to manage too, because you're not spread out across a dozen names. You got 4 or 5 stocks where you can watch every tick and you can really get a intimate feel for how they're moving relative to the S&P 500.
By the way, because I bought back those short calls on Crowd, the entire CDS is now in profit. It is now in profit, even with Crowd down $2.50 today. So part of doing spreads and it's also knowing how to manage a spread, because even if 5% of the time you're able to take a spread that is a loser And because you were able to properly time it, properly manage it, I saw that double bottom over there. You can turn it into a profitable trade. You do enough of those, 5 out of 100, you can flip your stats around very easily doing that. Sometimes, death by 1,000 cuts. Well, the opposite is also true, where you can make, a decent amount of profit with these small moves. If I get crowd, those 300 calls up to its original entry price of 427, then I will have made $1.57 profit from the trade, because I'll make 0 on the calls, $1.57 on the short calls. And so that becomes a very profitable trade of over $1,000 in profit on crowd. And all I need right now for that to happen really is for crowd to get up to close to 299.50, somewhere where it's been earlier today. Crowd gets to 299.50. I have a very profitable trade on my hands in crowd.
I have a question that brings up a good topic. So, isn't it better to buy calls that span earnings? Well, actually, first, the question is, isn't it good to get calls? We don't use get or give me. We use buy and we use sell. It might sound like semantics and like it's not important, but it is very important when you're talking about strategies. So I'm assuming you're saying you're buying calls. Do we want to buy calls that span earnings so that you can capture the IV, even if they're more expensive? So the premise there, yes, when we buy premium, we want to buy calls or puts that expire after the earnings announcement. And the reason for that is that they are going to retain implied volatility. The implied volatility might actually go up into that earnings announcement, and that is going to keep the time premium in those options very, very high. But we are not holding those options over the number. The intent is to trade the stock before that earnings announcement and to buy those options that expire after the earnings announcement, but to be out of the position before the number. Because once that number hits, all of the option implied volatilities are going to contract.
Remember, when you hold over a number, you're banking on 2 things. One, directionally that you're right. As Pete said earlier, that's a coin flip, right? We've seen with earnings just this season so far, the limited number of earnings that came out. It's a coin flip, right? You have great earnings, it drops. You got bad earnings, it goes up. But let's say, okay, you directionally get it right. You also have to know that you're betting that the market makers are wrong, because that premium that's built in is, okay, so let's say you bought the calls on a stock and going to earnings, you're betting it's going up. Well, so did the market makers build, they bet on both sides, and they built in, let's say, $5 worth of premium. They're betting that this stock's going to go up $5. So now not only did you have to have the direction right, but you better be right about that it went higher than the market makers thought it would. So you have to get 2 things right. So even if you get the direction right, you can still lose if you did not beat the market makers. So you have to have 2 things go well for you, not just one, to be able to make money on earnings. Unless you're getting like 0.95, and by the way, when I do play earnings, you notice I'll get the 0.8 or 0.9, usually the 0.9 delta. I try to take the market maker part of the equation out of it, right? The deeper the delta, the deeper in the money, the less you're paying per premium, the more you're getting 1-to-1 on the stock. And then it's just a matter of the direction. But the handicap you're giving yourself by having to get both the direction right and prove the market makers wrong, that is a really high hurdle to go over.
Which I have put up our pre-earnings options table so that I can show you. These are all companies that will announce after the close today or before the open tomorrow. So this is your last chance to take a position in these. There's a calendar spread that you can trade. It's a very effective method. Dave Wise came up with this strategy, and it is taking advantage of very inflated option implied volatilities for the weekly options that expired this Friday versus the 1 week further out options that expire a week from this Friday. And so you can see here what the expected percentage move is for the underlying stock. And this is calculated based on the at the money straddle that you would buy. These are all end of day prices from yesterday. And you divide that total by the price of the stock. And so you can see, okay, well, MPW, they're expecting a 22% move in the underlying, AAL, an 11% move. And you can see what the average move has been over the course of the last 12 quarters, 3 years. And how many times has the stock exceeded this expected move? We've also calculated that over the course of 3 years. And here you can see what those percentages are. So if you're doing a calendar spread, you want to make sure that you're looking for companies that have not exceeded that move very often and that have a good differential between the option implied volatilities that expired this Friday and a week from Friday. When you have those ingredients, you've got a very nice earnings trade setting up to do that calendar.
BWS, what do you look for in price action to indicate that it's worth buying into a position? We're not waiting for a pullback first when you'd want to wait for that pullback. Relative strength, relative weakness, really. I mean, you know, if I'm looking at something like Roblox, yeah, it's getting a little bit of a bump here, but I'm looking to see, did this stock show relative weakness or any of the times where SPY popped up a bit? And it did. It was relatively weak. So I'm not going to wait around for a pop in the stock when it's relatively weak. It's very unlikely. Doesn't mean it won't happen. Doesn't mean you're never going to get a perfect entry price. It's, anyone who tries to is going to just drive themselves crazy. But I'm looking for relative strength and relative weakness in the stock. I'm looking for how, if a stock is close to VWAP, I'm going to wait. I'm going to wait usually to see if it's going to break through or break under VWAP, but if it's far enough away from VWAP with relative weakness, I'm not going to wait around to see if it goes higher if I'm shorting the stock. Anything you look for, Pete, that
let me address that specifically, because again, as I mentioned earlier, we need to have specifics, and you mentioned Roblox. So let's take a look at that and let's construct a trade. So you come in yesterday, here's what you see the S&P 500 do. You got this nice little gap up, it's preserved. We closed near the high of the day. Beautiful bounce for the S&P 500. All right, well, S&P 500, we know that we've had some selling pressure too. So we've got this little tailwind working in our favor. We know that gaps up have been faded. That's why we got these long red candles. So you're just watching the market. You're seeing, okay, yesterday we had signs of a bounce. This morning we come in. We know that gaps have tended to be faded. So now all of a sudden, I've got the S&P 500 falling below VWAP. And we've got this long red bearish engulfing candle into the gap, new low of the day. This is a decent place to short. I'd feel pretty comfortable. And we're below the prior day's high. Okay, got a little bearish cycle working in 1OP. So the groundwork is set that I might have a day trading short setting up. Now I start looking at the underlying stock, and I see on a D1 basis that RBLX yesterday, it's below that 200-day moving average. And what did it do yesterday when the market was in go-go rally mode? Well, it tried to rally early, but as the market continued to move higher, what did the stock do? It continued to sell off, and it closed very weak. I'll put the SPY up. And so now you've got this stock kind of earmarked that, hey, this is a nice short. If the market sets up for a short, this is one I want to consider. See, gray line, SPY, stock, market up yesterday, stock finishing on its low. So today you come in, and now you've got the table set for, hey, where am I going to find a good short? RBLX. I already knew that from yesterday because it didn't bounce. And now you can start to see it wither. And now that you've got that market cracked down with that bearish engulfing candle right here at about that 1010 level, all right, this is a place where I can feel confident taking a short in RBLX. Plus, it's starting to fill in the gap from yesterday, the gap up. See, this is a gap up. Now we're into that gap. Yes, I feel comfortable. Stock is weak D1. Stock is weak M5. Market looks weak M5. I have all the components for a really good short. Checkbox, 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 checkbox. That's how you do it.
Pete, Harry, thanks so much for all that you do. Can I ask you, how do you each personally deal with a poor trade which hits your confidence in the past? Well, there are different answers here. Obviously, it depends on how meticulously you journal. First off, if you journal well, you have stats. You look at those stats and you say, okay, how much is my recent performance deviating from that stats? If one trade is going to affect your confidence and you put way too much into one trade, right? You're way too oversized. But if you look at your performance, if you have a baseball player, they hit, an average 300 and they're in a slump. Well, they can look back at their average and say, okay, I know I'm a 300 hitter. I'm in a slump now. I've been in slumps before. I come out of it and I compensate on the other side. I get hot. The average is out 300, right? So one is you look at your stats and you say, okay, I am well off of my normal stats here. This is just one of those turns in the market. Like, this is a difficult market to trade right now. It's not a straight bull market where you can just throw a dart and, buy some calls or buy some stock and you're good. So the market is difficult and maybe that's affecting your stats. Or you can look and say, okay, that's if you're doing everything the same. However, if you can find a problem, that actually should help your confidence. Finding the answer, finding the reason. Oh, I was stupid. I love the stock. I love this, but I didn't take the market into it. Well, that's a big problem, right? But let's say I didn't take the market into account. I didn't take the fact that we're kind of in a wait and hold mode, or I didn't take the fact that the CPI was coming out into account, or whatever it was. Well, at least you have identified the problem. So that's not a confidence issue. That's I'm not going to do that again issue, right? But if you're looking at something and go, oh, this is the same problem I made, the same mistake I made last time and the time before that, well, then you're fucking up. Then you're not learning, right? Okay, now that your confidence should rightfully be shot. There's a time where you should take a confidence hit because you're not learning shit and you're making the same mistakes over and over and over again. So yeah, you shouldn't be confident. But if it's a mistake, you identify it, you can fix it. That shouldn't affect your confidence. In fact, your confidence should go up that you noted a mistake, you fixed the mistake, and you moved on. So it really is identifying, was this a mistake? Was the mistake something that I can fix? Was it something I didn't learn? Or was this just the normal ebb and flow of trading and my stats are going to prove out at the end?
That was a really good answer. You need to dissect what went wrong early on in your trading journey. You're going to make a lot of mistakes, and it is really important for you to learn what those mistakes were. As you start to become a more seasoned trader, there are many times I'll have a losing trade, but I would do that trade over and over again 100 times, knowing that 9 out of 10 times I'm going to win on that trade, okay? And so often, let's say, for instance, right now, and usually you can trace back most of your mistakes, novice traders in particular, to not gauging market movement properly and not sizing properly based on what the market is doing and what your confidence in the market should be. So let's use an example right here where, okay, Pete's buying this bounce on the S&P 500 and he's buying stocks with relative strength. And so I'm cool with that. I've added starter positions, and let's say that I'm completely wrong and that everything falls apart. Okay. No, my thesis that we're going to get a bounce was wrong. So I'm going to exit my starter long positions for a loss here. But the information that I get is that, this is a lot weaker than I thought. And now we're getting a double top lower high. And I'm starting to see this little bounce falter very, very quickly. I have no issue flipping the switch and going into RBLX or Uber or Lyft shorts that we've shown you today and saying, yep, I might have lost a little bit of money right here, but I am going to make a shitload of money when this market falls. And I've got the shorts already set up, and I've got my alerts ready to trigger. And whatever little bit of money I lost here because I was wrong on the market, I will make back because I have new information. And hello.
And don't forget, by the way, Devin, look, there are some things, let's just be honest here, you know, are sort of more deep-seated problems. I mean, look, we all know the person who they go out on one date, they get rejected, they come back, their confidence is fucking shot. It doesn't matter if they're good looking, they got money, they're funny, they're this. One date turns them down. Could have been for any reason, but you know, and they're just like, that's it, I'm done, it's over. And then you have the other person who can get shot down 9 times out of 10 and each time still go out there and be confident. Some things are, there are some people who are just more prone to the woe's me, and that's when your confidence is not connected to reality. So whenever you lose confidence on whatever it is, make sure it's connected to reality. Is reality boring out what my hidden confidence is reflecting? Is this make sense? Because a lot of times it won't. A lot of times you're over exaggerating the hit to your confidence. It's something that reality doesn't bore out. Sometimes it does. And the bigger problem usually are idiots that are overconfident when they shouldn't be. And it's the same thing in reverse. If you have too much confidence, again, is that connected to reality? Is that connected to results? You can't be arrogant and incompetent. You can't be both, right? So both ways kind of result ways to look at it. Thoughts on Lulu? Fucking Lulu. No thoughts on Lulu. Lulu's flat today. Yeah, it bounced off a low here at 416. Since earnings, the thing got smashed down. I mean, I don't even know what you're thinking here. A Lulu long, a Lulu short. When I can't, here's a hint. If I'm looking at a chart and I can't tell if you're thinking whether or not I should be short or long, probably best not to trade it altogether. Just make that a general rule. There you go. Boom. Answer.
Yeah, I look at that and I'm like, I don't know if it's going higher or lower.
Right.
I had a question on PayPal, and I'm not seeing a whole lot in PayPal that gets me thinking one way or the other. It's got some support below, and that's good, but the stock really doesn't have any momentum. It's just really very choppy. Okay, so if I compare PayPal right now to BAC, which was my pick from Sunday, okay, remember what PayPal looked like. This is what I want to see. Look at that nice tight price action in that rally, okay? This is strong. You get a little bit of a dip. You've got your earnings reaction right here. Stock is above the earnings reaction. Market down, down, down. Stock marching higher before the market even bounced. That's what got me excited about BAC. But look at how nice and tight this price action is, and look at how the stock has been breaking out to a new high. One more shot at PYPL. And you need to compare these two charts. You should be doing this with all of your holdings. Look at this. This doesn't have any kind of consistent movement to it. I'm trying to guess which way it's going to go, and it's not giving me any clues. What was the one before? Lulu? I mean, Lulu, the only thing I could say about Lulu is it's been a big drop. There are sellers here. I think as soon as it hits resistance and this bounce starts faltering, if I get that market breakdown that I was mentioning earlier and I was wrong on the market, this thing starts showing relative weakness, I would have no problem shorting this on the notion that it's going to at least test that low and probably break through it.
I mean, look, last month, every month I put some stocks in my son's account. My 18-year-old, soon to be 19-year-old son, that's what he wants. He wants stocks. I bought PayPal for him, not because of the current technicals on PayPal, but because of the fundamentals on PayPal. And as a good long-term investment, PayPal is probably a great stock to buy at this price. But in terms of trading PayPal, there's nothing there right now that I see that would make me jump all over it. Yeah, it might not be a bad long. It's not terrible. It's just nothing. You're like, Pete, there are better charts out there to trade. But don't confuse. Sometimes people will look at that and say, oh, fundamentals, I should go, well, that could bear out in 6 months or a year from now. chances are your trade won't take that long, I hope. Is margin trading enough to make a good living from relative strength, relative weakness strategy, or options necessary? Depends on how much money you have. Generally you need options because options give you leverage. If you're looking at a $25,000 account or even a $10,000 account, whatever it is, you're not going to make much money trading stock. Now, I prefer stock. You're not paying for the privilege of trading it. Your stock is more direct. But if you're trying to make a living, which is what your question specifically asked, was making a living off of it, you're going to need to utilize options somehow. You're getting 100-to-1 leverage on those. You're paying the premium, yes. But the money you'll make on options compared to the money you'll make on, at BABA, for example, I bought 7 calls on BABA, right? That controls 700 shares. They're $70 calls. If I had bought, if I wanted to do the equivalent on buying shares in BABA, I would have to be buying close to $49,000 worth of stock. That is a little bit, no. You're not going to make the same amount. So if you have, a couple $100,000 in your account, sure, go. The more you can go straight stock, the better. And you'll notice in the larger account when I trade, I'm a lot of times trading stock. A lot of times I'm going straight stock because it's just better to use straight stock. I can buy on the bid and sell on the ad. I can do all those things. But if you're looking at a lower account, you go with the options.
That's a good point too, Harry, is that, early on in your career, you're pressing, trying to work that capital because you don't have much of it. You're in one stock, it runs hard, it really looks nice, but it's starting to lose its momentum. You're out of that one, you're in the next one. You've got bullish put spreads on, you're making great money on it, but gosh, I need to release that margin and I've got another bullish put spread I like better. You are working that capital morning, noon, and night, because you have a certain amount of income that you're trying to generate on that amount of capital. When you become a successful trader, and what happens later in your career is that you don't need to push the envelope as hard because you've got a big capital base. And so now you don't need that leverage anymore. And yes, you're more inclined to trade stock. I like to trade stock. I don't need to trade options. And for many of you who even have 4-to-1 day trading margin because you're above PDT, 4-to-1, you're able to buy a lot of stock and you don't need to trade options. So you figure, if you're making depending on your capital base, if you were trying to double or triple your account every year, and now you have a much bigger capital base, if you're making 40-50% on that larger capital base, you're perfectly happy with that. And you can do that trading shares. So eventually, seasoned traders really shift into trading more stock than options. At least I have.
Mm-hmm. Looks like SPY's heading back up to VWAP here, probably for maybe a test. I'd like to see, before I started getting excited with longs, I'd like to see a pretty clear break of VWAP on SPY, see if we can head back up to the day's highs around 507 and break through there. If not, then we might just hit VWAP and then reverse. So I'm kind of watching closely here. I mean, these are the times of the day where it's best to keep your powder dry, right? Where you see SPY, you're getting a nice rebound, and your initial thought, go long. You have VWAP right there, and that is your natural testing point. Investors know it, traders know it. You're going to come right to it. If you blow through VWAP with volume and you're just going straight up, okay, that means there is something pushing, something propelling this market buying going on. But if you're approaching and you're inching it up like we are here, nice and organized, you're looking probably at a tested VWAP, maybe a little breakthrough and then back down again. Let it play itself out. Let the day play itself out. See if we can get SPY back into green territory. If we do, and it sticks, then you can actually be pretty confident in your longs that we filled the gap, went down to the low, and then bounced right back up through VWAP and it confirmed. That gives you a lot of confidence in going back long. wait till that happens.
And so I'm going to recap with your pick, Bob. I'm going to take a look at it right now. So we've been doing this for over an hour. This is kind of where Harry put the long out, was back in here. You can see how the stock had preserved the gap when the market was still selling off right in here. And you can see how it holds all these gains. And now the market starts to find a little bit of a bid. What does the stock do? It rallies. Where is the stock? It's above VWAP well before the market was. Relative strength, M5. So it's doing all the things that we want it to do, all the things we expect it to. PANW. How has that responded? We've got this stock also holding the low and not drifting lower when the market was heading lower. Okay, market continued to head lower. This stock had found support at the low of the day. As soon as the market finds support, whoosh, that's what you want to see. And Harry, I'm going to conclude the session by just saying we're both kind of in the same camp. We're going to lean on this D1 strength here for the S&P 500. We had a bounce above the 100-day moving average, which if you're going to get a bounce, you would prefer to have it above the 100-day because it tells you that buyers do not believe we're going to get there. And they're aggressive before it even gets there. So we've got major news coming. We're looking for continuation. And the key to adding to bullish positions right now will be that we blow through the 50-day with a long green candle and heavy volume. Then we add. Anything else you'd like to add to that?
No. I mean, other than right now, that BABA position is up $45 on 7 contracts, and the market dropped from when I got it. That is the definition of relative strength.
And one final note too, is you did an Apple trade while we were on today too. So let me bring up Apple. That thing is screaming higher. So you should be doing well there. Well, it's not screaming higher, but it's been up. So it's actually doing well with the market here. It's
actually a little bit higher than when I bought it. And by the way, someone asked if using leverage, why is CFD not as good as options? No one said they aren't as good as options. You just can't use contracts for difference in America. That's all. I mean, I'm doing this from the US and I'm using US-based platforms and I can't get CFDs, but they're pretty damn similar. So they're both leverage-based. You don't need the underlying ownership to capitalize on a directional movement instrument. So there's no one's making any type of aspersion either way about CFD versus options. So just, if you're in Europe or something, fine, use CFDs. I don't care.
And anytime you use leverage, options, CFDs, whatever it is, liquidity becomes a concern. The stock is always infinitely more liquid, and just for slippage on the way in and on the way out, that's why I prefer to trade stock. I would prefer not to trade against the market makers in almost all option instances, unless you're trading SPY or Apple or something uber liquid. I'm going to be trading against a market maker, and I'm dependent on that market maker making a good, fair market for me and not spreading out the bid-ask spread, because there's nobody else to trade with me. And I don't want to have that. I don't want to lose that control. I want to preserve that control as long as I can. The stock, infinitely more liquid. I can always get in and out very easily. I can buy bids. I can sell asks. I cannot do that when I'm trading options. Thanks so much for attending, everyone. Good luck with your trading. Watch those big news events. Hopefully we'll get some good earnings announcements and we will get the bounce that we're looking for. Trade well. Great. Thank you, Harry.
Thank you, everyone.
Bye now.
Have a good night.